welcome back everyone. The restaurant industry has always been a great place to look for some home run stocks, with names like Domino's Pizzas, McDonald's, Wingstop all becoming multi-baggers. That's over 10x returns in some cases. But over the last year or so, the restaurant industry has been facing some difficulties. Well, in fairness, actually everything has, everything excluding AI. But seriously, restaurant stocks are facing some of the sharpest drawdowns that we've seen in a while, with names like Chipotle, Cava, and Sweetgreens currently down 40, 50, and 80%. And with 2024 also registering the highest number of bankruptcies for restaurants since COVID, the sentiment is souring and turning extremely negative. And that's why I thought it was actually a really good time to start looking at some potential bargains. However, my search went a little bit off track, and instead of researching one or two stocks, I kind of ended up researching the entire industry as a whole. And yeah, that was a lot of information to sift through, but the goal was to try to answer the question, how can we pick the next 10-bagger or multi-bagger restaurant stock? But actually, it became pretty clear that wasn't the right question to ask. And instead, what I should have been asking is, what do the best restaurant stocks do differently, and what do they avoid doing? Because there are a lot of terrible companies out there. In this video, we're going to try to answer all that and more so that you feel more informed about how to pick restaurant stocks moving forward. All right, so I think we should start with just a little bit of macro. Even though you might be saying to yourself that you never think about macro, we're all implicitly thinking about it whenever we're considering margins and growth rates. So as you're all probably aware, inflation as measured by the Consumer Price Index has been more persistent over the last number of years than Jerome Powell and the Fed would have liked. Inflation continues to run ahead of wage growth, and that gap matters. Even though the paychecks may look larger on paper, the real spending power of the US consumer has been quietly shrinking. Food inflation has been one of the biggest forces pushing the CPI higher. For consumers, that means essentials are eating up more of their monthly budget, and certain food staples, especially beef and eggs, have been increasing in price over the last number of years. And at the same time, labor costs are rising, and they already make up close to 30% of a restaurant's total sales. And in many states, higher minimum wages are pushing that figure even higher. And while there was a pretty strong trend over the last decade of people eating away from home, that trend appears to be reversing. The Restaurant Performance Index has just seen one of its steepest declines in 20 years, as you can see in this chart. And at some point, the market taps out and there simply isn't any more room for growth. Costs rise and the consumer pushes back, and suddenly the restaurants are getting squeezed from both sides. And that's when the cracks start to appear. The restaurant chains that took on too much debt, grew too fast, or ran sloppy operations begin to struggle. And you're going to see plenty of examples of how things went wrong in the restaurant business. But before we get into that, let's quickly recap the different dining segments in the restaurant industry so we're all on the same page. First, you have your fast food joints, known as your quick service restaurants. Brands like McDonald's, KFC, and Taco Bell. And the key thing they're offering here is speed and value. And over the last 3 months, these stocks have actually held up pretty well. A lot of that comes down to the consumer trading down to cheaper meals as the economic environment gets tougher. Now, moving on from fast food, we get casual dining, your Applebee's, Chili's, Texas Roadhouse, that whole group. And you might assume that given the higher price points, this segment would be struggling. But consumers have been voting with their wallets here and gravitating towards the value-oriented options that offer more bang for your buck. And these two segments, QSR and casual dining, look very different. Casual dining carries a heavier cost structure because it requires table service, bar staff, and hosts that typically drive the labor costs up 5 or 10%. And then we have the newest entrant to the restaurant industry, which is fast casual. Think of it as the middle child, a hybrid that's trying to blend the speed of quick service and the premium pricing of the casual diners, hence the name fast casual. The focus shifts to better ingredients and trying to appeal to the more health-conscious consumers. But this group has really struggled as of late with their core Gen Z demographics showing signs of weakness. And this has hit their bottom line, leading to a drastic decline in the stock price, as we mentioned already. Now let's talk about the two different types of models in the restaurant industry. Many of you are probably aware that a lot of the restaurants operate through a franchise model. The big advantage for the franchisor in this setup is pretty simple. It's an asset-light model, and it doesn't take much capital to grow, and the company earns a steady royalty stream from its franchisees. These companies usually start with low revenue, but because the model is so efficient, growth translates directly into margin expansion, and you get massive operating leverage. Domino's Pizzas is probably the best example of this, and they've executed the model really well by investing into technology and automation and consistency to an extreme. But the franchise model isn't perfect. One of the biggest drawbacks is that you lose a lot of the operational control, and you can't easily force franchisees to renovate, modernize, or follow a turnaround strategy. Just look at Applebee's. They're heavily franchised, and when they needed a system-wide refresh, franchisees weren't exactly lining up to spend money. So Applebee's actually is now buying back some of those franchisee stores themselves in order to renovate them and show proof to the rest of their operators that this is actually beneficial for them. Now let's take a closer look at the royalties. This is the money that the company earns directly as a result of sales through their franchisees. In most cases, royalties are a percentage of sales, usually in the 4 to 5% range. But here's what most people don't realize. There are extra layers of royalties baked into the system. Things like marketing or advertising fees get added on top of the base royalty, which means the real royalty rate franchisees pay is much higher, and with most restaurant franchises ending up charging 9 to 11%. Some brands even take it a step further. Burger King, for example, charges something like 30 cents per digital transaction, claiming it covers the cost of running the digital app. It's obviously a tiny number per order, but extremely profitable for the franchisor or the parent company. And it does make you wonder, are the franchisors and the franchisees actually aligned? In a perfect world, you'd want a royalty structure that rewards both the sales and profitability. So the franchisor or the parent company has a reason to help the operator succeed, not just push for more sales. Chick-fil-A is probably one of the few that actually uses a model closer to this, but they're very much the exception, not the rule. And this whole question of incentives keeps coming up in the franchise models. And we'll come back to it later when we get into more examples of what can go wrong. All right, let's move on to the other major restaurant model, one that's a bit simpler to understand. You can call this owner-operated model, company-operator model, whatever you like. This is actually the traditional setup where the company owns and operates its stores directly. Examples include Chipotle, Cava, and Brinker International, which is the parent company of Chili's. We've already established that the franchise model is asset light and can grow extremely quickly. In contrast, the owner-operator model flips this. It's a lot more asset heavy and the growth tends to be slower because the company has to fund all of the operating costs and reinvestments all by itself. Owner-operators also take on most of the financial risks themselves. In a franchise system, that risk shifts more to the franchisee. However, as you'll see later down the line, poor execution can still come back to bite the brand and create long-term problems for the franchisor or parent company. But the biggest difference between these two models comes down to the economics of it all. The owner-operator keeps 100% of the sales and 100% of the profits, while the franchise owners, as we've discussed, keep around 9 to 11% from royalties. And one last thing to mention, something we touched on earlier, turnarounds are generally much more achievable in an owner-operator model because the company has full control over their operations, so long as private equity is not involved. Just take a look at Red Lobster and TGI Fridays. Evidence so far is beginning to mount that companies that are owned by private equity firms are significantly more likely to go bankrupt than those aren't. So the good thing though is that we're in the public markets. So for the most part, we should be safe, but it can still happen. So it's important to ensure that you're aware of who the owners of the business are and whether their incentives are aligned with shareholders. All right, great. So now let's imagine that you've gone ahead and found a company you like. You understand what type of restaurant it is and you know which business model they're running. So what should you do now? What should you start looking at? We're going to run through our restaurant investing checklist, if you will. I'm going to assume that most of you are already familiar with the basics: revenue growth, operating margins, and the standard financial metrics. But even if you're not, don't worry. Everything we're about to cover is pretty intuitive once you see how it ties back to the business. All right, so the first thing you want to keep an eye on, and arguably the most important indicator of a restaurant's health, is same-store sales growth. And according to McKinsey, there's an 80% correlation between same-store sales growth and total shareholder return. Basically, more same-store sales equals higher stock price. And I've put together a list of some of the publicly traded restaurant stocks with the largest revenue across the US in this table. And looking into the same-store sales growth over the last 3 years, you can see Texas Roadhouse, Cheesecake Factory, and Shake Shack as the top 3 leaders for this metric. But this alone doesn't tell us the full story of the stock's performance. Let's take a look now at the store count growth. And now we're starting to see a bit more shakeup in the ranking. And Cava stands out as a clear leader here, showing tremendous growth. And that's even more impressive considering it's an owner-operator model rather than a franchise model. But there's an important detail to keep in mind here when looking at store growth, which is churn. This might be a concept very familiar to people who invest in software or technology stocks. But in restaurants, churn is when a franchise restaurant shuts down and the franchisee owner or parent company just turns around and sells that same location to a new operator. And therefore, it might show that this new store growth is much higher than it actually is. And therefore, we should take a look at net new stores instead. And another important metric to keep an eye on is the average unit volume, or AUV. This is simply total sales divided by the number of stores, and it's a great way to evaluate the profitability on a per store basis. The growing AUV is exactly what you want to see. It usually signals strong demand for this concept. But on the flip side, and just as important, when the AUV starts to slow, that often signals diminishing returns starting to show up. Payback periods begin to stretch because each new store takes longer to earn back what it costs to build. Cheesecake Factory, one of my personal favorites, has one of the highest AUVs in the entire industry. And that matters because their average build-out cost is around $5 million. You need a big AUV to justify that kind of investment. But what's even more striking is seeing Portillo's up there as well. This is a company with relatively small footprint, around 100 stores, mostly concentrated around the Chicago area. And what that tells me is simple. This brand has massive loyalty, and you don't hit those kind of AUVs unless customers are genuinely obsessed with your product. And although this company is going through some turbulence right now, after both the CEO and CFO left in quick succession, it might be one to keep on your radar. All right, so now that we're familiar with these metrics, let's peel back the onion a bit further. Every restaurant has three major costs: food, labor, and rent. And once you account for these, you're left with the store level profit or the store level margins. This is a really useful metric for company operated chains because it shows you the core unit economics before any corporate overheads get added on. In other words, it tells you how strong each restaurant is on its own, regardless of how fast the company is growing. Cava, for example, reports around a 24% restaurant level margin, which is very healthy for a company operated model. But not every company gives you that metric. So if they don't, you might be able to find the EBITDA margin as a proxy for the operational profitability. That's earnings before interest, tax, depreciation, and amortization. But if you really want to compare different restaurant models, you need to also factor in their lease structure, whether it's owned or rented. But you still need to be careful which companies you use to analyze this with. And although McDonald's earns a lot of royalties from their franchisees, there's something else driving that 60% margin. You see, McDonald's is actually a real estate company. And that's why sometimes it's very hard to compare apples to oranges, and why we should look at some other metric like ROIC, which is the return on invested capital. ROIC helps standardize everything. It tells you how much every dollar invested is earning back as a return, regardless of whether the model is franchised, leased, or company run. Look at this table of ROIC. Domino's Pizzas, Taco Bell, and Papa John's are all top performers, while all the way at the bottom we can see Red Robin, floundering, and it's also recently filed for bankruptcy, I believe. And sometimes the best place to hunt for companies to invest in are those that have just inflected ROIC positive. These have a chance of offering a longer runway of improving margins before things stabilize. And by the way, at the end of the video, I'll share the overall score for each of these companies based on the four metrics we've just covered. Now, let's briefly talk about the balance sheet and talk about what matters most, which is debt. Debt ratios matter a lot for franchise chains, especially the franchise parent company, which often runs with pretty high leverage. Take Wingstop, for example. They've issued multiple special dividends that were funded using secured loans. This can be a pretty big red flag. Funding dividends with debt can signal financial engineering and a willingness to burden balance sheet to reward shareholders today rather than reinvest for long-term growth. By the way, don't worry, I'm not going to go any deeper into the world of financial engineering into this video. But if you are interested in finding out more about how restaurants can cook the books, so to speak, I'm releasing a follow-up article on my Substack that breaks down the tricks and accounting moves some restaurant chains use to mislead investors. And that article might come out in a week's time, so be sure to subscribe to stay notified about when that happens. All right, but let's imagine that you found a company you really like using this checklist. It's got very strong same-store sales growth, great AUVs, and impressive growth, not to mention their ROIC. But maybe you're still not fully convinced. You like the company, but you're still not sure. What else can you look at to build your conviction? Well, some of the other metrics that might be helpful could be revenue per square foot. This one matters a lot for restaurants that rely heavily on the dine-in experience, places like Cheesecake Factory, Olive Garden, or Texas Roadhouse, for example. You'll usually find this metric buried somewhere in the annual report. And for context, some of the top fast casual restaurants can hit around $700 per square foot. And you could also check revenue per employee. It's another simple metric, but it can tell you a whole lot. If this number is falling or way below peers, it might signal operational bloat, meaning that the business is carrying more headcount and overhead than it really needs. And just for context, data from Aaron Allen, which I've referenced a few times, is a great resource for you to check out. And according to their research, the top performing quartile, or top 25% of companies, generate around $75,000 in revenue per employee. Now, do bear in mind that most of those are probably not going to be your casual diners, so it needs to be compared apples to apples again. Okay, so this next one might be a bit more esoteric and less familiar, but you guys are here watching this video, so I'm not going to sell you short. And it's a real factor to consider for restaurants, which is labor turnover. High labor turnover can quickly destroy a restaurant's performance. From higher training costs to lower service quality, slower kitchens, and inconsistencies across locations. Some resources even suggest a single hourly restaurant employee costs around $2,700 once you factor in recruiting, training, and lost productivity. And replacing a general manager is even more expensive at $12,000 to $17,000. So it's important to ask why people are quitting. Is it because they're on minimum wage? Or is this a restaurant that's paying above the minimum wage, such as In-N-Out, for example, where they have the highest level of satisfied employees? The fact is that in some cases, you might be paying higher employee wages, but actually due to better staff retention, you're lowering all of these retraining costs. Another low-hanging fruit that's easy to find is the Google reviews. I know it's simple, but it's a pretty useful alternative data source. I've used this myself when analyzing Cava's footprint, and I was genuinely impressed to see that the average restaurant rating for all 415 stores across the US was 4.5 out of 5. Another simple qualitative check you can carry out is to search job sites like Indeed and Glassdoor. You can look up a restaurant chain and see its overall employee rating, plus also what staff are saying about working there. And another thing I stumbled upon was Glassdoor's best places to work in 2025. And guess what? In-N-Out Burger ranked 3rd overall. Shame it's not a public company, but this is exactly the kind of research you can do to find these competitively advantaged businesses. Okay, now let's talk about location strategy and customer demographics. As shareholders, we usually focus on margins, unit economics, and growth rates. But it's worth stepping into the CEO's shoes for a moment and asking 2 basic questions. Where should we open new stores, and who exactly are we building this concept for? Take Chipotle, Cava, and Sweetgreens, for example. They're all targeting the same 25 to 35-year-old demographic. And what makes it worse is they're doing it in exactly the same geographic hotspots. New York, California, Texas. Everyone is fighting for the same crowd. And it gets even more concentrated when you zoom into the Gen Z cohort. They're heavily clustered around the urban areas, and according to the State of Consumer Report, Gen Z is the group most willing to splurge on premium offerings, even more than millennials or older generations. So naturally, every modern fast casual brand is piling into the same cities, chasing the exact same spending behavior. Meanwhile, Chili's has a completely different footprint. They're spread across major cities and across the Sun Belt. And they've carved out success not just with their value-oriented menu, but also with some surprisingly effective viral marketing, especially those famous cheese pulls that really resonated with the younger audiences. So what's the point of all this? Simply to help you spot and diagnose potential issues early. I'm not saying you're the one who's going to be deploying these locations, but just be familiar with what the weaknesses or strengths are of the business. As far as other headwinds you can try to spot about locations, cannibalization is something that shows up most often in the franchise-heavy models. I'm not talking about Hannibal, I'm talking about territorial cannibalization. And this all really comes down to misaligned incentives. Remember when I mentioned we're going to come back to this? Franchisors or the parent companies want more stores, they want more royalties, more top-line system growth, while the franchisees want healthy unit economics and protected territories. And when those incentives clash, things get pretty ugly. Some franchisors allow multiple franchisees to open stores just a few blocks apart, and it forces operators to battle each other for the same customer, even though they're technically under the same brand. A famous example of this is Quiznos. Franchisees became so frustrated they filed a class action lawsuit, and not only were their territories being encroached on, but Quiznos was also the sole food supplier. They began raising the prices of the ingredients by as much as 30% above market prices. That padded their corporate profits but destroyed franchisee margins. And the class action lawsuit was ultimately settled for $200 million. The franchisee's trust was shattered and Quiznos eventually went bankrupt. So the lesson here is that we definitely want to avoid companies that are behaving unethically and that are destroying value from the inside out and not aligned with shareholders and the franchisees or partners that they have. But not every company is built that way. Some companies actually excel at aligning themselves with shareholders, especially when the founders are still involved. And Cava might be a perfect example of that. A few years ago, they made the bold move of buying Zoe's Kitchen, a competing yet struggling Mediterranean chain with more than 200 locations. But here's the genius part. Cava didn't buy Zoe's for the brand. They bought it for the real estate footprint. They converted those Zoe Kitchen stores into Cava locations at about half the cost of building new ones from scratch. Was it a risky move? Yeah, sure. But the execution was spot on and it accelerated their growth by a number of years. What's even more impressive is how they handled things before they ever got big. Barry Shulman and the founders didn't want to take on more outside money. So they literally took out personal loans with their wives co-signing to open the next 2 stores. This is the stuff that actually matters. It tells you a lot about the people running the business, the management, and how they think about capital allocation, and how far they're willing to go to execute. So speaking of execution, try to put yourself in the CEO's shoes. You've considered your location strategy and demographics you're targeting. What else should you consider? You can consider investing in optimizing supply chains. Wingstop, for example, has a whole strategy around long-term contracts for chicken wings to ensure stable pricing. While Starbucks, on the other hand, has hedging strategies that mitigate against volatility in the commodity price of coffee. So it's worthwhile asking, in whatever restaurant concept you're invested in, what's the weak link in the food supply and what is management doing about it? All right, so what else can a CEO do? Well, investing in automation is probably a big one these days. The goal here is pretty simple: to improve efficiency. If you can automate the most repetitive parts of the food prep, you can reduce your labor costs, increase throughput, and make the line move faster. And when it's executed well, it can meaningfully improve store-level margins. But not every investment in automation turns out to be well allocated. Just look at Sweetgreen. They spent nearly $70 million acquiring Spice, an automated kitchen startup, back in 2021. And just a few years later, they've had to sell off the asset after running into financial trouble and then lease it back. So things are going well for you as a CEO. The next lever you're considering, and was always there in the background, is acquisitions. Now, acquisitions are tricky. They can work, but they're the exception, not the rule. Look at Yum Brands, for example. They own KFC, Pizza Hut, and Taco Bell. And that portfolio has worked out incredibly well for them. But for every Yum brand, there's a long graveyard of acquisitions that just went wrong. Just look at Fat Brands, the owners of Fat Burger, Johnny Rockets, Barbell Slab Creamery. They are currently at the cusp of bankruptcy. The reason isn't solely the acquisitions, but ultimately bad execution of the acquisition was a large contributor. And therefore, as an investor, it's also worth keeping an eye out for the intangible assets to total assets ratio. This basically tells you how much a company has historically overpaid for acquisitions. The higher that number is, generally speaking, the more the company relied on expensive deals. So the lower this ratio is, the better. All right, so you have successfully carried out multiple initiatives from improving operating efficiencies to acquisitions, but growth is starting to stall. What else can you do to re-accelerate revenue in this business? Well, you can offer some value-added services, right? The main one you decide to implement is a loyalty program because of how effective these can be. Chipotle, for example, has 45 million members and drives recurring purchases with high frequency and predictable behavior. You're also looking into merchandising because it's a great way to increase revenue and brand awareness and sales, especially around the holidays. And why not? Who wouldn't want this cute sweater for their 3-month-old niece or nephew? All right, so you're on a roll here, driving more revenue to the business. Analysts are asking what's next in the pipeline. Little do they know that you've already decided on going retail and selling your specialty sauces and spreads in grocery stores. Think of Chick-fil-A sauces, or for my UK audience, Nando's. This additionally increases the brand awareness and is a customer acquisition tool as well, and it diversifies the revenue stream even further. One final trick up your sleeve as the CEO is to start rolling out limited time offers, or LTOs for short. These are all the rage right now, and companies need to be careful how often and how many varieties of LTOs they are offering, as it can dilute their core products. But Taco Bell has been executing this strategy really well with their test kitchens and are bringing back their natural fries for a second round. That actually sounds pretty tasty to me, to be honest. And lastly, in this day and age, companies need to be able to leverage marketing and social media very well. And we've already discussed one example of this, which is Chelly's Cheese Pull, which has gone viral on TikTok and actually increased their engagement considerably. All right, so thank you for sticking with me as I rambled through that. Hopefully now you can start researching the restaurant companies a lot more easily with a framework of what you should be looking for. And as promised, here is the final ranking based on the 4 metrics we looked at earlier in the video. Now, quick reminder, please do your own research. None of this is financial advice, and honestly, this has been a fairly surface level look at these metrics, and these names still require real due diligence. But a few names I'm personally interested in are Portillo's, Cava, Cheesecake Factory, and yes, I do love their cheesecakes, so I'm a bit biased there, but all depends on what price I'm able to get those stocks at. So maybe my next video might be a heads up or versus video where I compare Cava to Chipotle or Cava to Sweetgreens or one of those other companies that might be an interesting situation right now. And do let me know if you're interested in that video in the comments below, and hopefully I'll be able to put something out regarding that fairly soon. Additionally, do keep an eye out for my Substack because I will be releasing a lot of my valuations through the Substack, as well as the article about the financial engineering if you are so inclined. And until next time, have an amazing day and take care.